All right. Well, hello, and thank you for watching today. My name is Mark McColgan, and I'm the Director of Operations at Practice Evolution Partners, or PEP for short. At PEP, we help practice owners navigate the complicated nuances of selling to corporate, while at the same time negotiating maximum value on the sale of your practice. As part of this process, we do believe that education is crucial to your success, which is what brings us here today. So as part of our speaker series, we have industry-leading financial advisors, Jeremy Reinbolt and Christopher Britton. They have extensive knowledge and experience in finance and will review strategies that practice owners can use to help maximize corporate cash flow, preserve wealth, and mitigate tax and risk. On top of that, they're going to highlight ways you can take advantage of your holding company to increase your net worth and stop tax leakage. So with that brief overview, I'll pass it over to you guys, and you can take it from here.
Thanks so much, Mark. I'm just pulling up our presentation here. Let me just pull this up. Thanks so much for that introduction, Mark. So here we are today to talk about preserving wealth. We work with many business owners across the country, and one of the greatest opportunities we see to help people preserve and enhance their wealth is to mitigate tax leakage. So today, Chris and I's presentation is on the importance of tax planning and what you can do in your business, simple strategies to help you keep more of the money that you've made. Chris, do you want to talk about this slide? And basically, this is an example that Chris has built that talks about the effect of tax erosion on an investment using a 5% growth as an example.
Yeah, so this is basically there's a huge advantage to saving for your retirement or estate planning inside of a holding company, because the first $500,000 of your corporate income each year is only taxed at, depending on the province you're in, 11 or 12%. So you can effectively invest 88, 89 cent dollars and defer the tax on the dividend until such a point in time in the future as you would need it personally. So as long as we don't cross what I call as the personal tax line, you basically will get an interest-free loan from the government to invest for your benefit. And if you were able to invest long-term at 5% and not pay any tax, then you would have, and we're putting away an amount of money each year. At the end, you would have basically the advantage of having the top gray line at your disposal. But every year you have to pay tax. So because you have to pay tax each year in your company, you only get the dark gray line. And what's even worse than that is you don't have that money personally yet. So if you were to take the money out personally, you would only get the dark red line. So if we could grow wealth long term at a 5% rate of return, there is a huge advantage to being able to do that tax free or tax deferred.
Yeah, how I like to explain it as well is on a simple example. If you're in a 40% tax bracket and you pull out $100,000 and let's say you're left with net 60, just to get back up to par, you'd have to do 66% on your money. Sometimes people don't realize that without any proactive planning, there's up to 3 different layers of taxation on a business. And depending the province you're in, on your estate tax, you can end up paying up to 60 or even 70% taxes by the time it's reached your beneficiaries. So today we'll go through a few different scenarios of how you can mitigate that.
So what a lot of people don't realize is that on death, basically you're deemed to dispose of all of your assets at fair market value. Well, to the extent that you don't leave them to your spouse. So if you're leaving them to anybody other than your spouse, there's a deemed disposition, which means that you will have a capital gain on any assets that the value is greater than their cost base. And what a lot of people don't realize is that their holding companies that they own all their assets in, that is also disposed of at fair market value. And even though your investments inside of the corporation might have cost base, the actual shares of your holding company probably have very little cost base. So whatever the value of your corporation will become a complete taxable event on death and trigger capital gains tax.
So this is an investment that we use in a holding company that has incredible long-term benefits. You may or may not have heard of it, but it's called participating whole life insurance. And basically, you get this fixed annual deposit after you've been approved by underwriting. You can actually, once you're approved, depending on the amount of benefit that you've been approved for, it allows you to deposit more money in a tax-sheltered account. Essentially, all the money is pooled and managed by a life insurer. So some of the big ones in Canada would be like Sun Life, Manulife, or Canada Life. They have these huge pools where they manage these assets for their clients. And what's unique about them, among several things, two of the factors are their time horizons. So I look at hedge funds that, maybe have like 1 year time horizons that they're focused on their returns. And then you have private equity that's looking at, on average, maybe a 5 to 7 year time horizon. Life insurance looks into the decades, so 10, 20, 30, 40 year time horizons. And these pools are quite large, so the management expense ratios are very insignificant. They tend to be around 10 basis points. The funds also earn dividends, which can come in many forms, and they're also tax sheltered dividends. The growth inside the fund is tax exempt, and the death benefit is tax free, which we'll dive into this in a few examples.
The other thing is what I'd like to touch on is that the dividends each year that you earn them, you have a couple of options with them. One is that you can take them in cash, but if you take them in cash, then you're taking it out of the tax-free area that the government allows to grow tax-free. So therefore, it's kind of like pulling money out of your RSP, so they'd become taxable. You can also reinvest them, and when you reinvest them, it's kind of like if you had a bank stock and it paid a dividend and you reinvested the dividend, you get more bank stock. Well, with the participating whole life, you get more life insurance. So if your dividend in year one was $500, there's an actuary somewhere who said, okay, if Chris and Jeremy gave us $500 once based on their life expectancy, we would give them an extra $1,255 of paid up coverage. So your cash value goes up each year and your life insurance amount goes up each year. And each of those are exempt. But more importantly, once you've locked in that amount in your cash value, you can't go backwards. So if the stock market's down 30%, you can't have a negative year in your cash value of your power policy, which makes it attractive for financial institutions for borrowing against, which we'll get into in a couple of slides.
So here's a case study of a 50-year-old male. He's a business owner, married with 2 children, too young to know if they'll be involved in the business or not, but earning about net income of about $500,000 to $1 million, depending on the year, and is able to put away about half of that. So $250,000 a year in savings, very focused on retirement, focused on maximizing their wealth and quality of life, and looking to advisors like us on how to do so. So here's a few examples of what we might propose in this scenario. So in this scenario, we're talking about the same investment we previously were, which is the participating whole life. We have the client putting in $250,000 over 10 years. They said, I can commit to this over the next 10 years. They have an insurable need. So they could take this money and put it in their holding company in a regular investment, which, as we had talked about before, has several layers of taxation before they can use it. There's tax on growth, there's tax to receive it coming out, there's potentially triggering, you're only allowed to have so much passive income in a holding company, so there's potentially triggering that. What we've looked at is what this would look like putting this through a participating whole life policy. So in this scenario, we have the client putting it in for 10 years, and then it shows the growth and then what the corporate tax would otherwise be if they had it in an investment. Over here, we have the cash values growing showing, highlighted every 5-year intervals of where they would be at, and then how much they can basically access in any given year of that as they're building up that plan, which is quite significant.
Yeah, and you can see that after year 5, you've got more cash available to you than you've actually put into the policy. So by year 5, you would have otherwise put in 1.2 million, 1.25 million, and the cash value of the policy is 1.255 million. So basically, after year 5, you have essentially now receiving free life insurance. And by year 10, the cash value is actually more than you would otherwise have in an investment account if you'd bought a 5% GIC. The other interesting feature of life insurance is it grows tax-free, and as Jeremy mentioned, it comes back to your company tax-free, but it also creates an account called capital dividend account that can actually makes it go to your estate tax-free. So this slide is layered on we're also looking at the estate values that are available for your family after you're gone. So we're creating an asset that you are able to use while you are alive, and you can leverage it, and you can do investing with it. You can use it in retirement, but we've also created a really good spot for your estate. You can see that at the end of year 1, even though that your investment is growing to 256,000 inside of your company, if you liquidated it out to your family after you passed away, they would actually only get 135,000 because of the dividend tax that needs to be paid on it. Whereas you can see the life insurance comes out essentially tax free. So at year 10, if you were to pass away, your estate would, if you had a 5% investment, would get 1.6 million, but with the life insurance, they would actually get 6.8 million. And the pink column there shows the loss to your estate by investing in a fixed income investment instead of in a life insurance vehicle.
So out by age 90 at life expectancy, let's say, you'd actually be out to the tune of $7 million, which would essentially be tax erosion. Is that right, Chris?
That's correct. Yeah. So if you go back to the graph that we showed kind of on the first slide, which is the gigantic tax erosion over time, related to A, it's just the tax that you have to pay, but B, it's the compounded value of that tax over a long period of time as well. So the far right column shows what you would actually need to get in an investment vehicle to get the same money out to your kids. So if you live to be 90, you'd actually need to get 10.15% each and every year in that alternative investment to get the same money out to your kids.
That's significant.
And we also talked about how this slide sort of shows the difference in income that you could otherwise generate. So you can actually get an income stream from these, and we've got illustrated here at age 70. So if at age 70 you made 5% all the way along, and you wanted to take out retirement income from your holding company, you'd have to pay yourself a taxable dividend, and you would net out 153,000, approximately 500 each year. And at age 90, you would have nothing left. So your total income coming out would be 3.2 million over time. Whereas if we leverage the life insurance strategy, we can get a significant increase in our income over time, and you can see it's 4.5 million. And if you live to age 90, the net estate value left in your company is still 2.6 million for your kids.
So literally about $1.3 million better off.
Yes.
Yeah, that's significant. And again, that money would otherwise be going to tax as you're pulling it out. So just a much more effective structure to run the money through.
Exactly. Yes. So this strategy was waiting until retirement to put the money to use that's in your power policy. Jeremy, do you want to talk about how we can actually use the money up front?
Yeah. So really what you're doing is you're creating a dual use of your money so that it can grow in the policy, and you can pull it out to either use it for income or you can use it for other investment purposes. The reason is because the underlying participating vehicle is so secure, as Chris had said, that the banks can lend against it 1-to-1. So in this scenario, which is becoming more popular today and more common, it's called an IFA, immediate finance arrangement, which essentially means, unlike the previous strategy where you funded the policy and you're receiving financing against it later for retirement income, In this scenario, you're able to actually extract the cash values or full premium amount out right away and use that money in other investments, creating a dual use of your money, which enhances the strategy and enhances the returns quite significantly. So what you're essentially doing is you're funding a policy, then you're taking the money back out and using it for other investment purposes. You're getting 2 tax deductions along the way. You're able to deduct the interest and the net cost of your insurance if you're using that money to generate income in other investments. So if we look at this scenario, this individual's once again put the same 250 in over 10 years, but the difference is every year they're borrowing that money back out. So they're taking the 250 back. This shows their cumulative cash flow that's coming out of the policy. So they're essentially just servicing the net interest, which is creating a nice deduction for them as well. And then all of that money's net of the loan is going to pay out to them in this column, this blue column, the net death benefit. So if we went to age 90, it's about $6.7 million. The after-tax IRR and cash flow is 8.77. But what's important is they've stripped out all that money to invest elsewhere. So if they had a higher IRR target on their money, higher than 8.77, they could have used those other proceeds elsewhere. It's very hard to accomplish that from a risk-adjusted return perspective because the par pool takes on risk that of a bond or even potentially less. The other benefit is you get the remaining CDA credit. So the tax savings on the CDA is $5.4 million as well. So it's very significant when you start thinking about intergenerational family planning and you get to a situation where you realize maybe you have an insurable need, which many or most business owners do. You're looking for tax benefits, and also you want to preserve what you're not using in your lifetime for the next generation. This is a strategy that we look at quite often where somebody has, built up some considerable assets and they have steady cash flow because that's what the banks like to see when they're approving these structures. So the process is you would get approved like you would for a traditional policy, but at the same time, you get approved for the financing against it at the bank. Once those are approved, then you can basically set up this, usually on average, it's about a 10-year structure. Chris, anything you want to add to this one?
Yeah, I just think I just want to highlight that. So the premiums are being paid each year, and then we're borrowing back the exact same amount. So what you essentially end up being out of pocket is the after-tax interest cost. So it's the interest cost minus the tax savings from the interest because you've reinvested it someplace, minus the tax savings from the net cost of pure insurance. And then after year 10, so it makes sense that the yellow column there is the net annual output of cash. The column next to it is the cumulative cash that you've put out. So in this case, you've only ever put out $374,000. And it's important to see that after that, each year we borrow back. The policy's cash value has grown enough that we're actually able to borrow back the interest cost each year against the policy. So the only out-of-pocket costs are for the first 10 years.
Yeah. Pretty considerable benefits. And what I like about it is it doesn't interfere with any of the traditional goals. So historically, some of the reasons why people, might opt out of life insurance, even though there's a need, is because they feel like it could interfere with their other growth goals. This allows you to do both. So to have all the benefits of the policy, but at the same time, bring the money back into your other goals, whether that be real estate, acquiring another business, investing in the markets. So it really works well, but there's definitely a lot of tailoring that goes into it, which is why you would want to work with an advisor for a structure like this.
Yes. And we work very closely with our clients' tax advisors and accountants as well to make sure that it's all structured properly and ensuring that the tax deductions are utilized properly as well. The other point that I'd like to make is that the IRR is an after-tax IRR, so it's not a pre-tax IRR. So even at age 90, you can see it's an 8.77 post-tax adjusted rate of return. So really, you're looking at a 17 or 18 pre-tax rate of return, and that that IRR does not include the tax savings from the CDA credit, which are just almost like icing on the cake or the extra cherry, if you will.
Yes. Yeah, bolstering the capital dividend account is a credible tool, again, to continue to keep preserving your wealth in the generations to come, especially generation two.
Yeah. And, our government has gone into significant debt, so I don't see the tax rates coming down anytime soon.
Yeah. So some of the other attributes, in case we didn't cover them, so we have talked about the tax sheltering nature of it. So if you have a traditional investment in your holding company, every year, if it's fixed income, you're being taxed as income, so essentially half. This grows tax sheltered. It's vested. So Chris talked about that. So if we, like this year, have a volatile year and you see your, stock portfolio or real estate drop 10, 20 or more percent, you will not see your cash values go down. It's vested, so the cash value will stay at the values unless you draw from them, which is why the banks will lend against it now 1-to-1. So essentially, if you have, say, $100,000 or $1 million in cash value, most major institutions you can go to and get dollar for dollar value on that, which allows you a dual use of your asset. And then we look at risk adjusted returns, or the Sharpe ratio, which is essentially, it's really hard to beat from a risk adjusted return standpoint. So as Chris had said in the previous example, the pre-tax returns would have been more like 17%. Where are you going to go find, a fixed income vehicle with that type of track record that's going to generate 17%? It's very unlikely. Even in the public equity stock market, maybe if you have an all equity portfolio, you're targeting about 8 to 10%. If you're targeting higher than that, you might be looking at private equity returns. But from a risk adjusted return standpoint, it's really hard to beat this. And we are a big fan of everybody having it as part of their asset allocation where it makes sense. So asset allocation in general is just something we want to touch on. A group I like to refer to as Tiger 21. So they're essentially a group of peer-to-peer investors that get together, they talk about their portfolios, and they release it quarterly. And the theme seems to be they divvy their money up fairly equally between private equity, public equity, and real estate, and then the remainder being in fixed income and cash. I'm a big fan of everybody always having a bit of fixed income and a bit of cash in their portfolio. Typically in retirement, people need liquidity to live off of. So you're never having to sell assets at an inopportune time to have the liquidity to live off of. And B, you want to have a bit of dry powder for opportunities to come up. So when you see the market being volatile, it's actually an opportunity for you instead of something that can otherwise be devastating. And again, that's where this PAR tool fits in, as kind of the fixed income cash component that can end up being a part of the portfolio to help diversify and offset risk. Any asset allocation pieces you want to add, Chris?
No, I think you've covered that pretty well.
Okay. So just other strategies to consider that we talk about. So wills and dual wills. This is predominantly for British Columbia and Ontario currently. Having a dual will in a company. It's so funny how a lot of people we work with when they're around, 40, 50, they're sometimes we need to give them a little extra nudge to be mindful of proactively planning for things like capital gains. But then it comes full circle when they're in their 70s or 80s and they're saying, Jeremy, Chris, how do we eliminate probate, which is a much smaller, call it tax? And one of the ways to do that is to set up a dual will for your company, which will allow things to bypass probate. There's another current strategy that I know tax lawyers will set up called capital gain stripping, which allows you to restructure your affairs and ends up being that you're able to take money out in the form of a capital gain as opposed to a dividend. On large numbers, that can be quite significant. Now, there's been multiple years where we think this might be going away, but it's definitely worth having a discussion with your tax lawyer about to see if that makes sense for you. Some of the use cases we see is if somebody needs a bunch of money out of their company to go make a large personal purchase, like buying a home, sometimes that strategy can make sense. And you want to make sure the essentially the opportunity outweighs any of the costs of setting it up. And then lastly, which we touched on in today's presentation, leveraging to create deductions. So, within reason, if you're comfortable to, and you're not over extending yourself, sometimes it can make sense to create a dual use of your asset to leverage to create deductions. So an example is in Canada, a lot of people acquire real estate using leverage, which enhances their returns. If you're able to pull that money out and use it, say, in other scenarios where you're generating income, you can actually make your interest cost less and create deductions, which can have multiple benefits. One of which is, we're coming into a higher interest rate environment, so it reduces your interest costs, and it also can bring down your tax exposure as well. Any other strategies, Chris, that you wanted to touch on?
I just wanted to circle back to the capital gains stripping strategy, and just to echo your point. So currently, in most jurisdictions, you're saving about 20 points in tax by doing that strategy. So you're getting your tax rate from 47-48% down to 27 or 28%. And there's significant planning being done in that area right now, and the government is aware of it. They have tried in the past to, back when they brought in the anti income splitting rules, or the tax on split income rules for all family members. There was a piece of that legislation that was also aiming to stop this capital gain stripping, but it became obvious that it had significant unintended results, and it would have caused any intergenerational transfer of businesses to be taxed at basically between 68 and 70%. So they pulled that back. I've been waiting for them to take it away now for the last 3 budgets, and it hasn't happened yet. But I would be shocked if it didn't happen either this fall or in the springtime next year in the budget.
Yeah. So these are things just to be mindful of, and again, things that you want to take advantage of proactively, because you can never go back and do it, when it's too late or gone. And this is why it's good to have periodic discussions with your advisors to ensure you're taking advantage of everything. And if you find yourself constantly going to your advisors, bringing them ideas as opposed to them bringing you ideas, you need to wonder if you need to add new members to the team. So I think, we covered a lot today. Common mistakes that people make. So we see this all the time, and it's to no fault of the business owner, but just life gets in the way between business and family, that it sometimes don't have a lot of time for planning. So 2 major ones that we see are outdated wills and outdated shareholders agreements, where we have everything set up, and we'll go in and do a high level review and find major planning holes that can cause issues to the family, both from an emotional standpoint or from a monetary standpoint, and just things that they've outgrown. So the amount of times I've seen that be an issue. So we really try to get ahead of that. You can never, of course, force somebody to update their will, but really try to help them make it easy to do so. Chris, what are some of the other common ones that you see for business families?
Yeah, so one is beneficiary designations on RRSPs and on potentially life insurance policies, because life happens. So sometimes, there was a terrible example of RRSP designation. It made the press here in Halifax a couple of years ago, where the husband passed away unexpectedly and tragically, but his RSP designation was to his mother, because he started his RSPs before he got married, and had never ever gone back and looked at it afterwards. And so all of his RSP money went to his mother instead of to his family. And for whatever reason, the mother decided that she didn't want to give it to his family, and she kept it. Which caused a court battle and lots of legal fees. But I mean, I see it sometimes just doing life insurance reviews, that the beneficiary, might have been a parent, and then there was a marriage, or it was a spouse, and then the marriage dissolved, and the beneficiary designation never got changed on the life insurance policy. So that's one thing that I see that's quite common. So I mean, you should be mindful of that and do reviews of those things periodically. And secondly, with life insurance policies, it's important to, especially with the planning that we discussed today, it's important to make sure that you've got it owned in the right spot. So, sometimes I've seen these strategies set up in the operating company because there wasn't a holding company in place when the policy was purchased, and it's never been moved. So the business is gone, and I'll give you an example of that as well. So there was a family where the business had passed from the parents to a child. The child was now in his 60s, and none of his kids were interested in the business, and he was trying to sell the business. And the accountant was a friend of mine, and he called me and he said, "I think we got a problem." And I said, "What's that?" He said, "Well, we're selling this business for this gentleman, and there's a life insurance policy on his mother in it, and the policy was worth about 2.6 million, and the cash value was about 2.2 million because she was in her 90s, and the cost base was 100,000." And they wanted to move it before the sale for a couple of reasons. One, they didn't really want to sell a company that had a life insurance policy on the mother in it, but two, because it was causing them problems for capital gains exemption purposes, because it's an inactive asset. And the problem with life insurance policies is they're not considered capital property, so you can't roll them from a tax standpoint. So in order to move it, it was going to cost them a $2.1 million income inclusion, which is taxed as pure investment income. So they basically had to decide to hold off on the sale because they basically needed to wait for the mother to pass away so that all those tax implications went away. So it's super important to make sure that when you're setting up life insurance policies, short term you can move them around and there's no tax consequences. But if you wait a number of years up the road, there can be significant tax in order to move them around. So you should be mindful of where they're owned and who owns them. And a second example I would give was there was a gentleman who had sold out to his two younger partners of his business, and there was a life insurance policy on him inside of the company. And as part of the sale process, he forgot to negotiate to get the life insurance policy out. And he went after the fact to try to get additional life insurance for his own estate planning and found out that he was uninsurable. So he said, "Oh, I'll just go get the insurance policy from the company that's on me." And he didn't realize that he didn't have any control over it anymore after he didn't own the share. So the two new share or his two partners basically knew that he was uninsurable and refused to give it to him because they knew it was valuable.
Yeah. And we see different scenarios or versions of this, unfortunately, too often, or hear about them anyways. And so really just try to get ahead of it by really being open and willing to work with a team that's going to give you good proactive guidance and ask good questions.
And I think it's important to have all of those things reviewed periodically, not every year, but just be mindful that every 5 years or 7 years you should go back and check your wills and check your beneficiary designations and make sure everything's still owned where it should be. And maybe the answer is yes to all of those things. Everything's fine, but I think it's important to have a periodic review.
Yeah. So I think is our next slide our contacts, Chris?
Here's our contacts here.
Yeah. So Chris and I work coast to coast. We work together with business families all across the country. Chris is an accountant that works out of Nova Scotia, and I'm a chartered life underwriter that works out of Vancouver, BC. We're very happy to help if you have questions or we prompted anything that you want to explore further. So feel free to reach out to either of us. We work together as a team, and we'd be very happy to help you.
Yeah, and yeah. So as he mentioned, I'm a CPA, and I've got an extensive tax background as well. So we're happy to help out with anything that you might want to reach out and ask us about.
Yeah, that's great, guys. You obviously point out the value that you do provide practice owners when it comes to financial freedom, and I'm just wondering. I just have a quick question on what does the relationship look like with you guys when a practice owner does want to get some help from you? How does that start, and how does that relationship evolve as you go? I'm sure it's very unique with everybody, but is there kind of a common process that you follow to help people?
Yeah, so I would say that one thing to note that's very important, we're not transactional at all. So even though we've showed a few strategies, these aren't set it and forget it. We're very much relationship based. We work with so many families as a team, and basically our process is we have an introductory meeting to see if there's a real need there, if there's a fit, and then we go into what we call discovery, which is to gather two levels of facts. So it's essentially, I call them the hard and the soft. The hard is the simple stuff, which is just the numbers, and then the soft is what are their goals, their challenges, the unique things going on in their family. And that's where our planning and analysis begins. And then usually there's two paths people go from there. They either want strategy specific, where they're like, take care of this specific problem for me, or they want everything holistically. Even if they want it all, I find it better to do it in steps as opposed to all at once, because it can be a bit overwhelming. The first year is really about paving the foundation of the planning, and there's various things we can do for them. And then from there, it becomes our recommendation phase. They choose what is a priority and we'll implement that. And then from there, it's just an ongoing process of review and bringing them ideas that come up that are relative to their unique situation. So always keeping them apprised of things we're seeing behind the scenes, because we're, through the associations we're involved with, we see what finance is saying, or kind of anticipating where the puck is going, so to speak. And then our job, it's a bit like chess, is to get ahead of it for our business families that we work with. And that's essentially it in a nutshell. Chris, anything you would add to that?
No, I think that's a pretty good explanation.
Yeah.
Yeah, that's great. All right, guys. Yeah, I appreciate this, and like they said, if you have any questions, please reach out to them, and you can find our contact information right on the website that you're watching this. So, thanks, guys.
Thanks so much,
Mark.
Mark.
Yeah, thanks for having us, Mark.